things are really, really expensive. Now, can they get more expensive? Yeah, but they're about as expensive as I've ever seen them. I've never seen, for example, a CAPE ratio at 40 and current earnings at 24 and a half. I mean, everything is really off the charts. So could it get higher? Yeah, it could. It might, but I think you have to think about this as saying that, I'm at least in the eighth or ninth inning. And when you think about it like that, maybe it makes you stop and think a little bit.
Welcome to Thoughtful Money. I'm its founder and your host, Adam Taggart. Short of a dramatic surprise in the next few weeks, the markets should end 2025 with another big double-digit positive return for the third year in a row. A string of three-peats like this is quite rare in the markets, which raises the question, can the momentum last in 2026? Or will the market's return start to mean revert? To discuss, we've got the good fortune of welcoming back to the program high net worth financial advisor Ted Oakley, managing partner and founder of Oxbow Advisors. Ted, thanks so much for joining us today.
Good to see you, Adam.
Ted, it's always such a pleasure to have you on here. I'm very much looking forward to this discussion. It's been too long since we've had you on last. A couple quick housekeeping things before we get to the meat of the discussion here. One, this is the first interview that I've recorded since I broke a tooth this past weekend and had to have an emergency tooth extraction, which was not fun. I'm doing fine now, but I will admit I'm very self-conscious about this gap that has been left, and I'm going to get a replacement tooth for it, but it's going to take like over half a year. It's crazy how long apparently this takes. So anyways, I am more than a bit self-conscious about this. Hopefully folks won't see it while we're talking here, although eagle-eyed people might be able to find out exactly which tooth is missing, but I'm not going to share which one. But anyways, if I seem a little out of sorts, it's because I'm trying to figure out how to talk without showing the gap.
Well, I haven't noticed anything. If you hadn't said anything, I would never know.
Okay, well, that's good to know. And just to make it clear for folks, it wasn't like tooth decay or anything like that. I literally just broke the tooth. And they said, look, your teeth were really healthy, which was what made the extraction so hard, because the rest just didn't want to come out. But anyways, thank you for that. Also, we'll talk more about this at the end of today's discussion, Ted. But you and the Oxbow team will be doing a free webinar for the Thoughtful Money audience next week on succession. Basically, if you are the one who is managing all the finances and the investing for your family, that's fantastic. But what happens if you can't be there anymore? Either you get incapacitated, you pass away, whatever, you decide just to give up the reins. It's something that a lot of this channel's viewers who are DIY investors wrestle with. They don't necessarily have a family member that they can hand that responsibility to. And so the question is okay, well, what do you do in those cases? So this is a topic of which you are very well experienced at Oxbow. And I believe we're going to be doing this webinar, I believe it's this coming Monday. That's December 15th, and we're doing it at 7 p.m. Eastern, correct?
Correct, right.
All right, and folks, if you're interested in attending, it's a free webinar. You can go sign up for it at thoughtfulmoney.com/succession. And again, folks, we'll talk a little bit more about that at the end of this discussion. But at this point, Ted, let's just roll up our sleeves and dive in. So I mentioned in the intro there, we've had 3 really robust back-to-back years of double-digit returns for the stock market. Is it likely that can continue into 2026, especially given whatever your outlook for the markets is? And maybe why don't we start there? What is your outlook for the economy and the markets right now as we head into the next year?
Well, Adam, it looks like, we'll be a little bit slower because, obviously, employment slowing down. That's one of the things that drives it, which probably, we may not notice it in the numbers here. We usually don't during Christmas and that period because people, for some reason, they dig down deep to make it happen. But next year, you're probably going to have lower employment. And when that happens, it'll have some impact on the marketplace. It wouldn't surprise me since we're ending the year like this, to have this roll on into the first quarter and be a pretty good quarter. I do think there's a spot in 26 where you hit a more significant high, probably, and then you have a bit more of a setback. But that could be second or third quarter. I don't know. But, things are really, really expensive. Now, can they get more expensive? Yeah. But they're about as expensive as I've ever seen them. I've never seen, for example, a CAPE ratio at 40 and current earnings at 24 and a half. I mean, everything is really off the charts. So could it get higher? Yeah, it could. It might. But I think you have to think about this as saying that, I'm at least in the eighth or ninth inning. And when you think about it like that, maybe it makes you stop and think a little bit.
All right, eighth or ninth inning. Okay, so that's got to make you feel like at some point, I'm guessing in 2026, you get to the end of the ball game. And as you mentioned, I think you said, yeah, maybe it could get a bit higher for a while, but then you expect it to have some sort of correction. I've talked with you long enough, Ted, to know that you have had a lot of concerns about the level of valuations. And so when you said that it could do well in Q1, could go even higher after that before things head downwards. Are you envisioning sort of like a blow off top? A lot of people have called this the everything bubble, and most bubbles end with a incredible but very short-lived mania where the prices just go higher than anybody could imagine for a brief period of time. Are you expecting something like that, or maybe something a little more pedestrian?
Well, it's more along the line. You got to remember all the 401, a lot of 401k money gets put in the market in January in the first quarter, and there's a lot of that happening now. And those people aren't thinking at all about a sell-off. They're just driving it into the market. So you'll have that happening. And then you'll have a bit of probably just inertia from, this year going into the first quarter. And yeah, you could have a peak. I mean, if I were looking for more of a generational top, I wouldn't say necessarily 26, but I'd say sometime happen in 26 or 27, because by that time you're almost a generation past the '08 low. And so you've got a whole generation that's never seen a really more significant bear, And so you got to remember that the market has a way of taking every generation and sort of humbling them down somewhere along the way. And I suspect that'll happen in the next 2 or 3 years.
Okay, and let's talk about that for a moment because you have been, in money management for a number of different cycles. And we've talked about kind of what a true bear market looks like. And correct me if I'm wrong here, but I don't think you don't think we've really seen a bear market since '08. 2022, sure, that was a rough year for investors. But on some long-term trend lines, we didn't really break below the long-term bullish trend. And it certainly didn't end with the kind of capitulation that I've heard you describe a true bear market has, which is when nobody wants to touch a stock and everybody just sort of swears off them for a good number of years. So I guess my question is, are you expecting when we get to the end of the ninth inning here, whether it's 2026 or 2027, that will be because we are entering a true bear market?
Well, I suspect so. Number one, if you look at demographics, by that time, 27, you'll have the average baby boomer be 72 years old. They're going to be taking money out of the marketplace. But the other side of it is that these things come and go. We're two standard deviations plus above the norm on these averages. And I don't think I've ever seen a level of complacency, even in the late 90s, any higher than it is today. I don't think investors generally wake up every day and even remotely think about anything that could be bad happening in the next year or two. They just stay the course and put more money in the same way. And I think the advisors do the same thing, which is one of the problems you have. But that's when you get everybody on one side, like we are now, and the economy runs on the market, then you got everybody basically set up for something that's probably not going to work in the long run.
Okay, so the way you're describing this, here's sort of how my brain is thinking, which is we have this very high degree of valuation and complacency that you just mentioned, right? So markets are very rich and nobody's really worried about it, about a downturn. Um, uh, we have the potential, as you've said here, for the jig just to be up, and eventually we enter into some sort of correction here, and so that could be a real surprise for people because, to your point earlier, um, I mean, it's been almost a generation of investors since the '08 great financial crisis. So you have these people that just, I mean, how long ago was that? That was
Yeah,
17
16,
years ago.
17. Yeah, yeah,
Yeah.
70.
So you've got a bunch of investors, retail investors, and you've had a bunch of Wall Street professionals who now have spent, a good chunk of their career and never been through a true bear market, right? So, you know, you got high valuations and complacency versus the inexperience of knowing what to do with a bear market when one arrives. And then you're adding on top of that this dynamic that I've talked a fair amount with housing analysts about, but I haven't talked to too many people in your line of work in terms of money management about it, about the boomers. Uh, in the housing market, you're looking at kind of like 20 years, or more, which is kind of the cohort of the baby boomers, of sustained selling pressure as boomers get to the age where instead of, for the past bunch of years, we've been having 10,000 of them hit retirement age every day. Pretty soon, and really even probably starting around now, you're getting to the point where 10,000 of them are having to downsize their house, either because they're heading off to the nursing home or because they're dying, right? And that's going to sustain for a long time, as I said. So that's going to have a lot of downward pricing pressure on the housing market because in a lot of cases, when a boomer leaves their home, the house gets sold, especially if they have multiple kids, because the kids don't know who should get the house. So they just say, you know what, let's just list it and let's split the proceeds. Is there an analog to that in the stock market where boomers are dying with their portfolio and then the portfolio has to be distributed? Is there any sort of selling pressure component associated with that?
Well, I think the selling pressure comes more, Adam, from taking care of them. As soon as they start waning as far as health or go into assisted living or that sort of thing, they start burning cash then. It's
Okay.
not like before. And so, the children or whoever takes care of it has to start liquidating to take care of that. And then they run into maybe some major things where they have to really spend a lot of money on health. I think that's one of the driving things. Secondarily, yeah, there'll be some of that fallout, but the thing is, when you have, no matter what, when you have everybody that owns the same thing, then all your buyers are in, you see, no matter how you want to calculate it. And
Yep.
so the next thing is when people start to realize, hey, I need to sell something, and you flip it and go the other way. And I've been through that before. You get up every day, the market's down, and it rallies in the morning for an hour or two, and you think, hey, it's going to come back. It never does. It's sort of like it is now in reverse. You get a down day, and everybody's no big deal. We'll be up tomorrow, the next day. And
Mhm.
that's what's happened. That's why people are complacent. But you flip that scenario in a bad market.
Well, so you flip it in a bad market, and again, you've lived through a number of different market cycles. Um, what you're talking about here, maybe I hate to use the word, different this time, but maybe a bit different this time because I think you're familiar with Michael Green's analysis of passive capital flows,
Yeah.
and he talks about the passive bid, and he's done a lot of really rigorous research to show that it's a big factor in stock prices. In fact, maybe the dominant factor right now. And he's almost kind of depressed by this, but he's like, I think it's going to continue for as long as passive capital flows are positive. But if they flip negative, which they likely will at some point, then watch out because you're going to have this sort of sustained selling pressure, just like we've had this sustained buying pressure for the past, couple of decades from it. So, as the boomers, to your point, as they're starting to get sick, needing to cash out on their financial assets, that is, like I said, maybe, 20 years or so of just relentless selling, and that may be what pushes passive capital flows into negative territory because rather than putting in, they're taking out.
Well, it could be. I mean, people are, they don't take losses very well.
Hmm.
So, if you start turning the tide on them and go the other way, then what happens to them is they say, well, I need to sell now before it goes lower. And it's a snowball effect is what it is. And, again, I think people have basically come to the conclusion that you're never going to happen. I mean, that's basically what I see with people doing. That's never going to happen, and so, you know, you can't really talk rational to people because they're basically irrational right now.
Hmm. Okay, so we've got people thinking, all right, it's going to be summer forever. You know, you're raising some issues that say, hey, look, winter's going to come at some point and could come as soon as next year. Um, I'm going to get to in just a second. All right, well, so how do you manage capital, which you have to do in this environment? And I don't think it's a go to 100% cash and just sit there environment, at least not yet. Um, Before we get there, though, let's talk about some things that are happening the moment that we're talking here. So the day that we're recording this, silver just broke out above 60, $60 an ounce. And silver's been on a tear all year, as has gold and the mining companies. Bitcoin is also surging today. I think both silver and Bitcoin today are up about 4%. And I think one of the reasons for that's being touted in the markets right now is people are thinking that they're sniffing out that the Fed is actually going to be quite dovish when we get the FOMC release tomorrow and hear from Jerome Powell's press conference. Now, by the time this video comes out, folks will know what Chair Powell has said. But anyways, curious to hear your thoughts right now on kind of the rallying in the precious metals, whether you think the Fed is indeed going to cut tomorrow, what you think the Fed's going to be doing in 2026, and then we'll get to a couple of other asset classes too that are on the move.
Well, we own silver and we own silver miners, have for a long time. I say a
Hmm.
long time, for a couple of years, but um, we we had we knew that if you look at sort of a real prices adjusted for inflation,
Hmm.
silver is not anywhere close to where it's been a couple of other times.
Right.
So you could still get a lot more out of silver. And I think all the metals really offer, it's getting to one of those things where countries hoard everything, Adam.
Hmm.
And so they're hoarding everything, every metal you can think about, every precious sort of mineral you can think about, and that's becoming a big deal. And I think in the other side of that is that they're just buying that instead of other things. How long does it last? I don't know. These things don't usually last a generation. They're normally like 4 or 5 year moves, but we can see. But I mean, we like I say, we own silver, we own the miners, and also some of the royalty companies that have silver on the royalties. But uh, just have to wait. Now it's broken out a new territory here, price wise. You'll have to see how people chase it. We're starting to see a little bit of chasing. Not a
Hmm.
lot though. Institutions don't own much of it, but individuals are starting to go the other way with it.
Yeah, and do you expect the institutions to jump in before this run is over? As you and I have talked about, I think over the years, Wall Street's not a big fan of gold and certainly hasn't been of silver for a long time. But more than anything, Wall Street loves momentum and the ability to make profits. And when there's a party going on, eventually it likes to join.
Well, I think I think the miners if the miners do really, really well and they're left out, I'm talking about Wall Street's left out of that, then the thing they would do is chase it. And that's usually what they do with any asset. They chase it at the top and just drive it higher. And that's when you see the volumes go up really, really big, then they're coming for that sort of thing. Same way with gold miners. And we haven't really quite got to that point yet. We got a little bit in gold mining here a few months ago, but the chasing's kind of slowed down a little bit right now. And generally, I don't see the institutions just trying to buy hand over fist in there.
Okay, but right now you're not. you're not changing your allocations. In other words, at least you're not selling your allocations, it sounds like.
No, we sold some of the miners about a month ago. Not a lot, I mean, but when you get large moves like that,
Right.
you know,
100% this
yeah,
year, a lot of them.
150, in some cases 150, 200%. You have to, you need to, at least in this case, take some off because you're not dealing with a company that's making widgets or making a product that's going to be around for, 20 years. I mean, these commodity cycles come and go, particularly in the metals. And when you get that kind of move and it just been sitting there for years, then you have to take some of it off the table. You
Mhm.
should, I think.
Okay. Um, I know we've talked in the past, you have said you don't really think it's sort of a 60-40 world anymore. And if I remember correctly, I think it was a 60-30-10 was sort of the new model you guys were taking on at Oxbow. Am I getting that correct?
Well, we had what we call a 30-30-30-10. We had a,
Sorry, that's it. That's it. I knew
yeah,
I was misremembering. Okay, yeah.
and we sort of have that now. We have, you know, 30% in short-term treasuries. By short-term, I mean less than 30 months. And then, 30% in basically in commodities or commodity-based things, and 30% in stocks. And that can be a value or growth company, and then about we think you need to keep 10% or more just for trading purposes. In other words, you're going to have situations where things get really cheap. We've had a lot of things get cheap this year that we stepped in and used cash on. Not necessarily household names that you'd see every day, but things that were really, really good buys. And I think that's what you have to do in this kind of atmosphere. I think the idea that you can buy a long-term bond now is not a good idea. Uh, I see people generally losing money on those for a long time. And to me, if you're buying 20 or 30-year bonds, you're making a bid bet on the fact that they can keep inflation in check, but I doubt that they can, over the long run. So that's why we wouldn't step out past, 24 or 30 months with the Treasury.
Okay, so let me just make sure folks took note of that. So the 30-30-30 allocation, 30-30-30-10 allocation that you think is more appropriate now is short-term safe debt instruments that are producing some income, stocks, commodities, all of those at 30%, then 10% basically dry powder to take advantage of opportunities as they come up opportunistically. You don't like long-term bonds I'm going to guess, kind of for the foreseeable future. My question on that is, and we'll tie this back to what the Fed, may do this week, is the Fed is in cutting mode again, and there's people out there that say, hey, look, if the economy is going to slow next year, as you think it likely may, Ted, that if it slows too much, at some point we're going to get all the intervention, the central planning intervention to try to, rescue things, and that at that moment, that will drive bond yields down, that will drive the prices of bonds up and the prices of longer duration bonds up even higher. So, that's sort of a short-term opportunity. Do you think that could happen? Do you think that that's not worth playing? That's more like trying to catch nickels in front of the steamroller, or is that a real opportunity?
Well, I think you're right on the short-term rates go down, but I don't think the long-term rates go down. To me, I think people will say, hey, I don't trust you, Federal Reserve or federal government.
Hmm.
They were going to try to keep this. Look at it right now. The 10 years stuck on 415, 420. You would have guessed with all the talk and everything we've had about lower rates and coming up here, on the decision that you would have seen that change as well, but it didn't change. And it's worse though on a 30-year bond. If you say, okay, I'm going to buy a 30-year bond today, and I'm going to say that I'll take 4 3/4 for the rest of my life, basically for 30 years.
Hmm.
I think that's a bad move. I mean, that's a long time, number one. And number two, you're betting on a government that's basically flat broke and going to be more broke. So to me, that's the worst of all situations.
Okay, I totally get that logic. Okay, So, do you expect, and again, I know viewers will know the answer to this by the time they're watching this, but at Oxbow, are you guys along there with the market expecting the Fed to cut tomorrow?
Well, I just assume from reading that they would. If you
Mhm.
see the people that have come, it's interesting. Jay Powell hasn't said much the last 2 weeks, but everybody else has been talking. He hasn't said much, and I guess he's just sort of waiting to see how the votes check out. But
Mhm.
it looks like that's what's going to happen. I don't think they need to, Adam, but it looks like if you think about it, we're one of the few countries, us and the Bank of England, that are cutting rates. Heck, everybody else is raising rates. I mean, look overseas. I don't know what we're doing. We obviously don't have a Fed that's independent, but we're in a different mode right now. And for them to be in and come in and get aggressive on the downside, it's just all political, and
Yeah.
it'll end up blowing it up again with inflation eventually.
And do you expect the lack of independence to increase as Powell gets replaced with the president's, latest appointee?
Well, it sounds like he wants a rubber stamp Federal Reserve, which is not good, really. They need to be able to do what they think is the right thing to do. And, there'll be a bunch of name calling as usual and all that sort of stuff, but it's not good. In the long run, they need to be able to look at the two things they're set up to do. But I think what's happened is between the Federal Reserve and the federal government, the last 25 years, 30 years, they've gotten so accustomed to saving the stock market, and the
Hmm.
stock market was the only thing that keeps the economy going, that they're stuck. And so they're probably going to do whatever they need to do to make things go, which may be lower rates significantly, but the hangover from that won't be good. That's the point I'm making.
So let's talk about that for a moment. So, we started this conversation with you talking about how richly valued the markets are.
Mhm.
And something that we've talked about in the past has been sort of the resultant K-shaped economy, right? Which is that the people who have assets have been doing great, where the majority that don't have many assets, especially financial ones, are getting increasingly left behind. And it's that top end of the K that's really doing the lion's share of consumer spending these days. So if we do get to a point where there's a substantial market correction, then you have a big negative wealth effect on that top end of the K. And then that impacts the economy. To your point, we've gotten to the point where the stock market tail is now wagging the economy dog. So yes, you expect the central planners to kind of rush in when things are starting to come off the rails and do whatever they can. But as you said, there's going to be a hangover process there. How bad do you expect that to get?
Well, what happens is, I think it'll look more like the Arthur Burns era of the 70s, where he would lower the rates, thinking that we're going to really get this thing going, and then inflation would come back, so he had to come back and raise the rates, and so that was sort of an experiment for 4 or 5 years.
Hmm.
And Burns was horrible as far as he didn't do the right things, and finally, really, Volcker had to come in and clean up his mess. And my guess is you'll have some instant, something happen. I don't know, in the next year or two, and it changes all of that. Where they can't they can't affect things as much as they used to be able to with just lowering the rates.
Hmm. Hmm. I've had a number of people on talking about sort of the point you get to, at least with monetary policy, where you're pushing on a string, where kind of no matter what the Fed tries to do, monetary policy, QE or whatever, it doesn't, you get the laws of diminishing returns where it just does less and less.
Well, I think too they'll just keep on printing. Because we have nobody in Congress, not at either party, no person. You never hear them talk about, we need to slow down spending and maybe look at this or look at that. It's just a spending spree. What have you done? It's all about themselves, really.
Right.
And we just spend money and waste a lot of money. And until something happens that'll bring you to your knees, like a World War II or a depression or a crash, something that you're not expecting, COVID, some things you're not expecting, then they can't control anymore. And I wouldn't be surprised if it's not something like that. I don't know, but there'll be a point where they can't control the outcome as well as they expect.
Okay. We're talking about some dark things. Let me try to channel the administration for a moment. At least Treasury Secretary Scott Bessent, who would say, "Hey, Ted, we've been working really hard here in 2025 to pass all the legislation we need to really start getting this economy goosed and strike all the trade deals and start reshoring jobs and bringing trillions of foreign capital in here, and we're deregulating and we're getting all this 30 plus billion of tariff revenue now every month. Like, just have a little bit of faith, man. Middle of next year, man, we're going to be firing on a bunch of extra cylinders here. It's going to be great." What do you say to that?
Well, the first thing I would say is I was talking to Mr. Bessett. Is Mr. Bessett, how many times have you had faith in the federal government for start with, number one? But number two, I think manufacturing jobs, and I may be wrong on this, but I think they've actually declined a little bit this year in the U.S., if I'm not mistaken. I think I've read that a couple of times. But the other side of it is they do these things to get back, like this $12 billion. They're saying they're giving back to the farmers. Well, they took it from the people that pay the tariffs. I mean, the whole thing is, see, that's crazy, that whole thing. And then you come down hard on China, and then you realize, hey, China's got the cards, we don't. And then I've got to go over and be a nicer part. See, all of that's it's just grandstanding, and it doesn't work in the long run. I do think this about what Scott Bessett thinks. I think deregulation is better. I think they've done that. I think they've done a great job on energy, on the way they're approaching it. They've got a really good energy secretary. I think there's 3 or 4 things that they've done that are better, be better for the economy. Whether it all pans out that way, I just don't know. We've run so hot on AI that if it slows down, then what's left to pick up the slack? I don't know. And
Okay.
I'll tell you, that's one of the reasons when we're buying companies, we just look at the company. We don't try to buy the averages or indexes or things like that, because that's all macro. But if I can take a company and look at it, I can tell you where we can make some money in that company, I think, over the next 5 years.
Okay. So fair to say your approach is a bit more of a Buffett type approach, where you're just looking for great companies that produce great cash flow and hopefully try to buy them at a good valuation.
Totally. I mean, that's what we do. And when you're doing that, you take yourself away from having to determine, what we're going to do on the world market and what's going to happen with the Fed. You're just looking at a value of something. It's a really good value, and you're saying, okay, I'm going to own that for various reasons. I mean, there's some really great buys this year. I don't think the average person bought them, but there's been some really great buys this year, and I think people miss that point. They just keep driving into the indexes, and the indexes are controlled by just a few companies, so they never get a chance to really own what I consider to be some really, really good businesses.
Okay. Well, let's talk about those great businesses that you picked up this year. And the other question I was about to get to, especially since you mentioned energy as one of the areas where you think the administration's doing well. I'm very interested to get your thoughts on the energy sector as an investment class, because it's been a real disappointing one for many years. But there's a lot of talk, at least amongst the folks that I interview now, that it might be starting to turn. This might be a good time to be investing in and try to catch its upswing. So answer that however you'd like, because I'm going to guess some of the companies you bought this year might have been in the energy sector, but you tell me.
We bought a lot of energy this year, but it's interesting. I know generally people are off on it, but most of our energy investments this year are up for the year. They might not be up 40% or something, but they're up from where we bought them. And if you look at the energy sector to me, over the next 2 or 3 years will be the best buy you can make right now. Because if you look at the dividends in that group, I mean, there's a lot of them that have 7, 8, 9% dividends. And, we just bought Petro Brazil, 12% dividend, biggest oil company in Brazil. I mean, all you got to do is get a turn. You have to realize you go much below $55, $56, and they won't be drilling. They won't be doing anything. You have to make enough money to do it. So, it's still a supply demand thing. And granted, you might be in a situation where for the next 5 or 6 months, you're just collecting the dividend. But if you look at that total return over the next 2 or 3 years, you're probably going to do really, really well. I mean, we bought numerous things this year in the energy section. There were dividends anywhere between 6 and 10, and that's great cash flow right now for this time we're in.
Okay, so I know that like nuclear plays have done great this year, largely banking on a lot of future investment by the country in this space. But a lot of the actual cash flows from that are years and years in the future. Oklo is a great example of that. They're not going to have a dollar of revenue for many many years, but the stock's
Right.
done fantastic this year. I assume most of the companies you're talking about that you're buying this year are more in the fossil oil and gas space.
Natural gas and oil. I mean, I think if you look at solar, for example, the way we've sort of played solar is we own silver, use a lot of silver in solar.
Yep.
And so we kind of go that different direction. But generally, we're oil and gas. We own one small company that's in the service business in the Mid East. That's a great little company, uh,
Hmm.
National Energy, NESR. So all of you out there, but it's a small company that makes a lot of money. Just signed a big contract, but that's the only service company we own. Everything else we own is either is really oil or gas, and gas has done really well for us this year, really well. But I think it'll do a lot better in the future. And so that's really where we are. We're if you look at what we've added the most to, it would be energy this year.
Okay. I just got to ask since you mentioned it. I've interviewed again folks who invest in this space, and a lot of them have been pretty bullish on the midstream companies. But
Mhm.
sounds like you guys only own one. Why only one?
Oh no, we own three or four. I didn't mean to imply that. What I mean is we own the gas producers that are not midstream. They're
Mhm.
actually producing it. We own
Yeah.
Antero, for example, Northern Oil and Gas. We own Apache or APA, which are the old Apache. But we own. If you look at what we own in the midstream, they're mostly LPs, but MPLX. If you look at Energy Transfer, Enterprise Products, see those are all paid on a K1, but our average yield on them is somewhere around 7.5%, which you can't get today, Adam, in a real estate deal. I mean, I mean,
Right.
I think, and they raise it every year, and so they've been great. We've owned those for many, many, many years. I'm talking about 20 years now, and a lot of them. And so, it's that's an area that if you look at enterprise products, we've been on that stock a long, long time. It's been a great company, but we own those are the midstreams we own. But they're almost all of those are an LP and they're on a K1, but we own the straight up gas companies too. And that's why we own when you look at on the oil, we've sort of separated on the oil, but we own various oil companies, Matador, like I say, we just bought Petro Brazil, and it's a good group. I mean, it's a group where you can make some money. We think the next 5 years, but you got to stay with it.
Okay. Well, thanks for clarifying. And I've been a silver investor forever, but I got quite bullish on silver when we had the price breakout at 35. And I know you follow me on X. You probably noted where I gave myself silver eyes at that point, and then one of my followers added laser beams to the eyes. So I've had silver laser eyes since 35, and that's proved out well now that silver is above 60 on the day that we're talking here. But I've been saying of late when I retire the silver laser eyes, I might replace them with oil eyes because of the potential for this industry to turn. And I think you share that optimism. Let me ask you this, Ted. Your firm is headquartered in Texas, so you know a lot of people in the oil industry. How much of your enthusiasm is because of your approach to valuing companies and just doing the homework you guys do on the fundamentals versus what you're hearing from people in the oil industry about their sense of its prospects in coming years?
Well, I think they generally feel good, and we've seen that business shift a lot on the private side. You see a lot of mineral business. In other words, a lot of royalty overrides, that kind
Hmm.
of thing, and they're making, and it's big. Everything's big now. It's not like you can't go drill a vertical well like you used to 30 or 40 years ago, and I hope you get a good well out of it because everything's horizontal. All the horizontals are getting longer and longer.
Right. Well, the easy stuff was extracted a long time ago. We got to go
Yeah.
deeper and deeper. Yeah.
Yeah, but that's kind of where the business has gone to. But I still say this, that they need a price to really expand that. They need a price, and it's not like they're not doing anything. But in the long run, a higher price is going to really expand that, I think, to a high degree. And so in the industry, and I hope people don't get irritated with him, but the oil industry is not a good industry for sentiment. At the lows, they won't buy anything.
Hmm.
At the highs, I think we're going up forever.
Hmm.
And so I used to laugh at a lot of them because I'll tell you a story back when the oil late 80s, it was I guess it was, I can't remember exactly the time, but oil was had gone down. It had gone down to about $10 a barrel or 11. And I asked this one oil and gas guy, I said, how long is what do you want to just go out and buy it? Because I said, well, how much does it cost to lift the oil? If you just drill the well, he said, that's probably about 14 and a half, $15 a barrel. I said, why wouldn't you just buy it then? And he said, because it might go lower.
Hmm.
So if you think about, excuse me, if you think about that, it's kind of it's contrary thinking, but that's kind of what the industry does.
Okay. All right. So don't rely too much on the industry sentiment because they oftentimes get it wrong, especially
Sometimes.
at the edges. Um, so a couple quick things. So I think you already said this, but I just want to really make sure folks listening understand it. Given your optimism, I don't think it would surprise you if the oil price continued to drop for some material period of time here, say into the middle of next year. You're not calling the bottom in oil here. You're just saying you like the longer term prospects of this space. And even with a declining oil price, as you said, a lot of these companies you own are going to be paying you nice dividends. And then if and when the industry does turn, you'll get the best of both worlds, where you'll get those dividends and a rising share price.
Yeah. Well, it's true because at the top, oil was 30% of the S&P, and I don't know what it's 3.5% now,
Yeah,
or
it's like a
whatever
low
it is.
single digits now. Yeah.
Yeah. So what happens is, yes, it could go lower, but we would just add to holdings if it did, because we would be getting more cash flow. And in the end, that's what all investing is about: is cash flow, no matter what kind of investing you're doing. But yeah, it could get weaker. It could get a little weaker. I wouldn't see it past 50, 55 though. I think you get down to that level, and I think people they just stop.
Mhm. Well, selfishly, I'm kind of hoping it weakens from here just because I
Mhm.
want to be able to dollar cost average in at lower prices in the near
Yeah.
term. I'll also say too, a lot of the natural resource experts that I interview, Rick Rule, being very notable amongst them. Rick says, look, if you look at the growth of world demand for oil and gas, it's just a ever increasing line, right? In other words, even though we've been investing in alternatives and we're excited about nuclear, it's not placing a dent in the world's demand for these fossil fuels. And he said, in spite of that, we have actually been decreasing our capital expenditures in recent decades in terms of exploration and development. And he said, look, even if demand were just a flat line from here, not even grow, he says, we're going to have some shortages in the not too distant future. I don't think you necessarily need to buy into uh, that theory to want to invest in oil and gas right now. But certainly, if Rick's true, if that proves to be true, that'll only add some pretty substantial tailwinds to this sector, correct?
Yeah, and Adam, there's so many places in the world that the only energy they have is combustible energy.
Hmm.
We forget about that in the U.S. That there's so many places in the world that's the only kind of energy they have. They don't have any other kind. And yeah, it'd be nice to have electric, but they don't even know what electric is in many cases.
I was
And
going to say,
so,
I mean, there's still, well over a billion people, maybe more, who don't have electricity or drinking water.
so yeah,
So,
you're right about that. I just think, you don't want to put the whole portfolio on energy, but it's just one of those things we think is undervalued right now.
okay. Anything else that's on your, opportunity set of, hey, this is something that we particularly like right now that we haven't talked about yet?
Well, we have two different sets. When we talk about that 30, 30, 30, 10, that 30 that's in stocks is in a different look. And we've been buying companies, just a few names that we bought, for example, in the last couple of months that you wouldn't probably think about, like Domino's, Gildan, if you own the t-shirt company that makes a lot of activewear, Mercado Libre, which is kind of the Amazon down in
Oh my
Uruguay.
goodness. Sorry to
Uh,
interject. That company was founded by one of my business school classmates, who I believe is a billionaire now.
well, probably is. But Autodesk, Bristol Myers, and those are in the stock side. Um, on the high income portfolios we run, now that's where we have a lot more energy, but also we have a lot of different other things. We own Vale, which is a Brazilian mining company, a lot of iron ore, other ores. Rio Tinto. Now these are all foreign companies, but they do great. You know, um, a great little fertilized LP that we own is really is CBR, and pays like a 12% cash flow,
Wow.
and that's a nice little LP. But they're different things we own over there. A lot of fertilizer we own, in copper we own different. That's where we have a lot of the commodities in that portfolio.
Okay. And in terms of portfolios at Oxbow, um, I'm painting with a very broad brush here, but as I recall, you kind of have three main portfolios that you're focused on. One is the growth portfolio, if we'll say, which is largely the equities that you were just talking about. And then you have two income portfolios, correct? One more conservative and then one more high income.
Right, the conservative portfolio is just for people that don't want to lose any money.
Hmm.
And so and there's you might not think this, but there's people out there like that, or they want a certain percentage like that, so they'll have more than one portfolio. The high income portfolio, though, is aggressive. I mean, we own things that pay a lot of cash flow, a lot of dividends, a lot of interest, and it's widespread. It's sort of worldwide. We own a lot of different things in there, but they create a lot of cash flow, and that's where we own a lot of the gold miners, gold, silver miners. All of that's in that high income account. And it's had a really good year this year. But we're running in that portfolio as good a year as it's had. We have about 55% still in short-term treasuries.
Wow. So even with that drag of just short-term treasuries, you're still having one of your best years.
One of the best, yeah. Our best years are always off market lows. That's where we have our best years, but
Right.
that's just because we have liquidity. We're not brainchilds or anything, but we have liquidity. So you can put liquidity in the market at the lows, and that's where you're going to get really, really big returns for a year or two.
Yeah. And your growth portfolio, the one that's much more just in equities, I recall the last time we talked, that was pretty healthily in T-bills too. In other words, you weren't fully invested in that portfolio. Where are you now?
It's about 38, 40%, probably right at 40. And it's only running on a risk adjusted basis. I mean, it's not running that far behind the S&P, but you have to think about it. Uh, it's a more conservative portfolio if I can have a really good return, but not have it all in the market. And so that's really where we come from on that portfolio.
Okay. So, uh, folks, just full transparency, I am a client at Oxbow, which is one of the reasons why I kind of know how the firm is structured there. And some of the things that I appreciate is the fact that the firm manages these three different portfolios. So, you can sample from all of them, right? You can say, okay, look, I want some of my money managed super conservatively. I want some of it to be getting income, and I want some of it to be striving for growth. So you have the ability there to kind of custom build your allocation. But I also like the fact, and this is me personally, you don't have to, your outlook probably shouldn't match mine. But I like the fact that even while they're striving to get the best returns they can, they are cognizant of the high degree of valuations in the markets. And so they have these cash reserves in the portfolios so that if and when there is a bear market, they've got the dry powder to then really lean in. And as Ted has said, the firm's best years historically have been the ones coming out of a bear market where you kind of have the blood on the streets. And it's the people who have capital to deploy when you've got those really cheap valuations are the ones who then really ride the recovery in the markets from then. So anyways, Ted, just underscoring why I'm a pleased customer.
Well, thank you.
All right.
I mean, everybody's the same. I mean, we don't really, all our portfolios are alike. If you choose one of them, you're going to look like everybody else. And it just depends on what you want, how you want to look at things. Everybody's different. We understand that. And generally, I think people today probably ought to take a look and say, how exposed do I want to be to the overall market? And we're seeing, I mentioned this before to you, but we're seeing more and more older people, 75 plus, 80, that have a lot of their money. I'm talking about 85 or 90% of their liquid assets that are in the stock market. And I just don't think they're thinking about the big picture when you're that age, and have that much exposed. But again, life's been good to them, so sometimes you can't make a case for them.
Well, it's sort of confirmation bias, right? You get
Yeah,
used to the way things have been, and then you say, well, of
right.
course they're always going to be this way. And this is what I think is the potentially nefarious trap of what you were talking about earlier, which is we're kind of a generation since the last market bear market. And so people have kind of just acclimated and said, you know what, I don't think the markets are as risky as they were. Even the ones who should know best, right? The older
Yeah,
investors, they've kind of they kind of just think things have been different. Of course, every year the market goes up double digits, it reinforces that bias. And as I said earlier, we've had three great back-to-back years, right? So
yeah.
let me ask you this. So obviously, if you are near retirement or in retirement, I think you would say, Ted, hey, be cautious. Don't be all in stocks the way that some of these people that you're seeing, seem to be, right? So one, just be careful. But for someone say my age, who's in their 50s, um, I've definitely been more conservative than the average investor. And I've seen people who, in my opinion, who have been more reckless than me do better than me
Mhm.
because they're all in the Nvidias of the world or the meme stocks or whatever, right? And they're playing the game as it's, you know, is working right now. I mean, I can't really fault them. They're getting rewarded for playing the game that's delivering a winning hand. It's just to me too risky, right?
Yeah.
Um, and I talked about that K-shaped economy earlier, where the bottom, half is seeing the top half get further and further away from them. Um, might there be an opportunity here if we get the kind of corrective event that you think might happen, where there may be the potential for people who are kind of paying attention and being prudent to kind of change their station here positively, to kind of almost slingshot into the higher echelon, which is avoid getting big losses if and when the trades that have been doing so well stop working and then maybe go into reverse, maybe pretty substantially, and then also have that dry capital to then put into play when there are really good valuations to then ride what comes next. So you might be able to take yourself from kind of a middle of the pack player here to a front of the pack player if you play your cards right.
Well, no question about that. I mean, when you get, I think the hardest thing for an average investor, though, Adam, is determining when is it cheap?
Hmm.
Okay. It comes off 15%, and they go, gosh, I ought to make a good buy. but it's like it was like for us in 2008, the market went from the Dow went from 14,700 to 8,800, big sell-off by the time we got to October. And then, believe it or not, and we put some money in. It ended up being great to put it in then, but we kept a lot of money back. And by the time you got to March, the first week in March of '09, we went down another 25%. We went to 6,600. And those are the points I'm talking about with people. I don't think the average investor is real good at knowing how to scale in and out.
Mm-hmm.
Um, they're like all or nothing. And
Yeah.
that's a tough way to run the business. You have to know when to scale in and scale out. If you have a huge winner that's gone up 15 times, 20 times, sell some of it. Take your cost out, take some profit out. You never know what the future is going to hold. And the same on the downside, you buy a little bit, it goes lower, you buy some more, but you're looking at a longer period of time. And I think the average investor, it just doesn't know much about scaling.
Well, this is one of the reasons why I recommend so strongly that most people work with a professional financial advisor because one, it sort of takes the emotional decision making out of your hands, and then you're also leveraging the expertise and the experience and the level head of the professional. Um, I also imagine if we do get this big corrective event in the markets, from what you've told me in the past, Ted, when it's the right time to buy, it's going to feel terrible to do so,
Oh,
right?
yeah.
This is when nobody wants to touch a stock and it feels like you're just throwing good money after bad and all that stuff. So you really have to have some sort of either framework or guide who is going to start guiding you on the scaling in then.
Yeah, for us, we just, we look at the single company, and
Hmm.
it may be so cheap, it's incredible. Not that it couldn't get cheaper, but if I could make a case to somebody, if you own this whole company, and it's real cheap now, and you own the whole company, you would buy this whole thing and just own it as your company because it will do that well over the next 10 or 15 or 20 years. And that's how you have to look at it on the lows. You have to decide, would I buy the whole company to really get aggressive? And that's really sort of the way we look at it. And it's the same way on the highs. If we get stocks that are so expensive, would we ever even think about owning this whole company? No. And so then you sell some. So it's on both ends really.
Okay. Well, Ted, look, this has been, as usual, a fantastic discussion. We're coming up on the hour here. I do want to spend a few minutes talking about the free webinar that your firm is offering next week on succession. So, I mean, we're going to get into the weeds of it in the webinar itself, but can you just talk for a minute or two about the importance of it? I mean, you, again, have spent a long career advising people. Your firm specializes in high net worth clients, especially entrepreneurs who have had a nice liquidity event after selling their life's work. Um, you've seen firsthand, the person who has worked so hard to build the family wealth, uh, but then need to say, look, I'm not going to be around forever. So how do I make sure that all this gets managed the way I want it to if I'm not around anymore? And I'm sure you've seen the good and the bad, people who have planned well versus people who haven't planned well. So why is this such an important topic?
Well, I think the biggest thing with it is you don't know what your future holds. And so, from an age standpoint, there are going to be things that you didn't expect. We get this every year, we get a few of these where one spouse or the other did all the investing, but all of a sudden they have Parkinson or a stroke or they're an invalid, they can't do it anymore. And then the spouse that's remaining uh, really has no idea. Now they don't even know who to trust. That's another. See, I mean, so you have to spend a lot of time with them just so they understand, hey, you can trust us to do the right thing. But see, that should have already been in place. You didn't have, I mean, we're not trying to take the car keys away from you. All right. I mean, well, my point is, you don't have to do the whole thing, but you need somewhere along the way to have a relationship with people so that and you may just get to the point, we've had people do this, is say, I'm tired of it. I don't want to look at it every day. I'm going to enjoy life. I want to travel.
Oh,
That's
spend
not
time
what
with
I
my
do.
grandkids. Yeah.
I'll tell you something else, and I'll mention this before, but now when you call, we have a lot of custodians, and I don't talk to them myself, but I know what goes on. And if you call, the Fidelities and Schwabs and the Vanguards of the world, all the big custodians, and you get somebody on the phone, about, a lot of them are just lost. So they lose you too.
Hmm.
I mean, what I mean is you don't know what you're trying to get something done, but you don't have the capability to do it. And that's when you got to start thinking about, okay, I could use somebody to really help me here a little bit. And again, you don't have to give them the whole thing. I understand there's an ego thing in there, but it's certainly something to think about.
Yeah, there's an ego thing of not wanting to give over the reins. There's also sort of a, you know, humans don't like to think about their own mortality. So
Uh,
it's one of these things,
yeah.
well, I don't want to think about it now. Maybe we'll do it later. And then, of course, potentially it becomes too late. And I think this is such an important topic for this audience here at Thoughtful Money because I know from the surveys I do to this viewing audience that like 75%, 80% of these viewers consider themselves DIY investors, right?
Mhm.
So they're doing it on their own, right? So, that's great. But, at some point, you're not going to be able to continue to do it. And so, to Ted's point there, you don't have to give over the reins today, but just like having a will and a trust is a prudent thing to do and an act of love to do in advance for your loved ones, figuring out who the baton is going to go to before you actually have to give it up is prudent in a similar act of love. And if it's somebody in your family, fantastic. And if they need a couple years of grooming time, of you educating them and getting them up to speed, fine, great. Just start that process now. But if it's not, and there are a lot of people I talk to who they say, no, there's, my spouse certainly doesn't want to, my kids aren't interested, or I just don't think they have the experience, I don't trust them enough to get good enough at this, then at least right now work on identifying who your successor will be. And if it's a firm, doesn't have to be a firm well, it doesn't have to be Oxbow, but I would say make it a firm as good, if not better, if you can find a better one. I think that's a tall order, but if you can, great, that's fantastic. And get that in place. And hopefully you don't need to pass that baton for, many years, decades, hopefully. But, just in case things happen faster than you think, at least you've got that plan B already set up. So
Yeah.
if you are interested in attending this, I think, very important conversation with Ted and the Oxbow team, again, just go to thoughtfulmoney.com/succession and you can sign up for free. And again, the actual event itself will be this coming Monday, the December 15th at 7 p.m. ET. And if you are watching this video after the webinar takes place, just go to that same URL and it'll redirect you to the replay video. All right, Ted, as we start to wrap up here, I guess last main question for you, is there anything else that's burning brightly on your radar about the markets, the economy, whatever, what you're hearing from clients that I just haven't been intelligent enough to think to ask you?
No, not really. I mean, again, I think and there's that complacency meter is really, really high. I mean, it's people are very complacent right now, and they just don't. They're not worried about it. And that goes back to that do-it-yourselfers. Things have been good so long that why would you ever use anybody else? So it all goes together. When you go a long period of time and nothing bad happens, then that's sort of what you end up with. But I think people need to really stop and think about history here. Go read a few books, and then you'll change your mind.
All right. Well, very well said. Well, folks, two things. Please show your appreciation for Ted coming on and giving us so much of his time and expertise by hitting the like button and then clicking on the subscribe button below, as well as that little bell icon right next to it. And you hear me say at the end of every one of these videos that if you want some professional help and you don't already have a good professional financial advisor who is advising you, that you should talk to one of the ones that this channel endorses. I highly recommend that. But if you want to talk to Ted directly in his firm there at Oxbow Advisors, there's a form to do that. Just go to thoughtfulmoney.com/Oxbow, fill out the very short form there, and the team at Oxbow will be in touch with you right away. I should manage expectations though, Ted. Your firm does have some minimums because you tend to deal with higher net worth clients. What minimum should we tell folks you've got here?
Well, and it's not that we wouldn't, people that don't have the minimum, we always keep them on an email list and try to help them as much as we can. We're just not going to be able to manage for them. But, you're looking at, typically, typically out of state, we need $4 to $5 million to manage that account. In state, not quite as much, but our average account size is going to be that size or higher. And we manage a lot of money that's higher than that as well. But we usually have 4 or 5 people on an account, so it's not that we're arrogant or anything like that. It's just that you have to look at the economics of it all, and that's where that comes from.
Okay. All right. Well, look, and when you say in-state, you mean Texas, correct?
Yeah.
Okay, great. So, folks, anyways, if you meet the criteria or you just like to talk to the team there at Oxbow, again, go to thoughtfulmoney.com/Oxbow. If you don't have enough to meet their minimum, but you'd still like to talk to one of Thoughtful Money's endorsed financial advisors, you can fill out the general form at just thoughtfulmoney.com, and you'll be connected with one of the other advisors there. Ted, thanks so much again, folks. Hopefully, we see you at the free webinar next week. And again, folks, to sign up for that again is thoughtfulmoney.com/succession. Ted, I can't thank you enough. You're such a gentleman.
Thanks a lot, Adam. Good to visit with you again.
All right. You too, my friend. Hope to see you in person at some point in 2026. Everybody else, thanks so much for watching.